we have not seen an era without federally introduced spending, without federally introduced forms of quantitative easing since the great financial crisis. So we have been propping up our economy for 14 years straight now. So we have distorted the prices of bonds and fixed income. We've distorted the prices of equities. We've created an asset bubble in crypto out of nowhere. And now we have to do the hard work of figuring out what the real supply demand is in the economy. And we don't know. It took
6 quarters here. There's 6 quarters of just massive GDP spike there from the preceding quarters. And we have 2 down quarters. Is it going to take 6 quarters to wash this out, or longer, I guess?
No, longer, because what David said is now making the problem even worse. So because Powell was catering to whatever pressure he's been getting, and he must be getting some severe pressure from the White House, those were really dovish comments. But what is the problem when he is dovish? Well, the practical reality is a couple of things. Number one is typically the yields of long-dated bonds go down. That essentially tells everybody else to reprice assets. What does that practically do? It makes the cost of borrowing roughly cheaper, okay? It makes the price of equities, particularly ones that are far out on the risk spectrum, so specifically let's focus on NASDAQ and crypto, right? Tech stocks, biotech stocks, and crypto stocks go up much more aggressively. So what has Powell effectively done? He has synthetically created a form of easing again, right? Like his job at the Federal Reserve, if you think about the money supply as a pipe, it's to shrink the pipe to close off demand to get things in equilibrium. So even though he's doing this, by the language that he's doing, he's effectively allowing market participants to basically guess that the worst is over and now we're going to start to expand the pipe again. And so they go to the end state. So what he effectively did in one speech is basically put a pin at the end of this year and is telling the markets, I'm mostly going to be done. And if anything, I'm probably going to be cutting in the back half of 23. Go on your merry way. It's now pushing the problem out another 8 quarters. Like, we need to stop this nonsense. He needs to be definitive, and he needs to fundamentally break the back of inflation so that you find out what the true demand is in the economy. People are really fixated on these numbers without understanding basic statistics. So just taking a step back, if you go to the Bureau of Economic Analysis, which is an official website of the government of the United States that posts GDP, the title makes it pretty self-obvious what we're dealing with here, which it says, Nick, you can put it up there. Real GDP, the percent change from the preceding quarter. So things can still go up positively, but still be negative if it doesn't go up by the same or more than the quarter before it. The thing that we really have going on is that over the last 8 quarters, we've had all kinds of very turbulent data that's made the trend line unpredictable. And the most obvious way to see this is actually in one specific subsector, which we'll get to in a second, which is around US e-commerce adoption. You see this one huge spike coming out of nowhere. And then eventually everything has settled back to trend. The same way, I think what we're waiting to figure out is how many quarters does it take for us to get back to on-trend growth in the economy. We had a massive shortfall in Q2 of 2020. We had a massive surplus in Q3 of 2020. We've had a country that's been getting back to finding equilibrium over the last 5 quarters. So we don't really know what the steady state growth should be. This is why I specifically had such an issue with the tone the White House took, which was trying to explain away that this isn't a recession by trying to create doubt in the definition. Instead, I think it would have been much better off just repeating what I just said and explaining basic statistics and actually showing that the country is headed in the right direction, largely speaking, from a really crazy one-time externality that nobody could have predicted, that it's going to take some number of quarters. And so really what you should look at, and Jason, you've pointed to this, is employment and wages, and try to be a little bit more circumspect in overreacting to any one quarter of data. By the way, the Fed exactly just said the same thing yesterday when they raised 75 basis points. They said, we are not going to give guidance anymore because things are too turbulent. We're going to remain vigilant on inflation, but mostly we're going to be very near-term data dependent. So I would boil all of this in saying, let's not overreact to a quarter's print here or there, and specifically the label. I think the White House made a mistake in trying to basically think, we all didn't understand what a technical recession was. I think instead we should just focus on what we have to do to get back to solid state equilibrium. We've never in the history of America ever had CPI print above 4.5% or 5% without inflation being brought down by having Fed funds not also be greater than 4.5% or 5%. At some point, inflation will turn over and we'll print 6 and 7%, but that's still not below 4.5% or 5%. And right now, our target Fed funds rate is between 2.25 and 2.5%. So we could still be only 50% of the way there if inflation remains at 4 to 5%. And this is what I think market participants don't want to hear. They don't want to hear that there has to be a meaningful form of tightening. And politicians don't want to hear that. The White House for sure doesn't want to hear it. The problem is that if Powell caters to too much of that feedback, he's not going to do what he's supposed to do and why he's put in that job.
The reality is we do not want Powell tightening more than he should or more than is necessary to solve inflation, because it will cause a serious recession. So I think we're caught between two pretty bad options here. And it's because I think that what happened last year contributed to this. I mean, look, if you go back to that chart that you just showed, what happened in Q2 of 2020, we had a very healthy economy going into 2020 and 2019, right? And then in Q2 of 2020, we had COVID, but we made the situation even worse with lockdowns. And we basically shut down the whole economy, brought it back, at least in most states, in Q3. And then the Fed started printing and Congress started printing $10 trillion. Well, still, by last year, the economy was back. We had something like 5.7% annualized growth. This year, it's negative. Why is that? I mean, this may be the lingering effect of all that stimulus, but I do think that the administration made it worse by sending checks into an overheated economy. They also created energy scarcity. So,
I'm not saying the White House isn't without fault, David, but I do think that if all of these geniuses could have actually just taken a simple econ and stats 101 class and explained how year over year measurements work to the American people, I think they're smart enough to understand it. We didn't have to go down this convoluted route. We could have just explained, we put a lot of excess money in the economy. We don't yet know what the full effect of that is. We need to let that wash through. In the meantime, you're going to see some crazy numbers from time to time, and we just have to be patient.
And the other crazy things you're going to have, looking at second and third order effects, is all these downstream effects. People are making business decisions going into these economies. Shopify just laid off 10% of its workforce, about 1,000 people on Tuesday. Their stock is down 10% past 5 days, overall 70% year to date. And if you look at this chart, and Toby took blame for this, he basically said, listen, we thought that this was going to be a, fast forward into the future, that people would adopt e-commerce in a major way and that would stick. Here's US e-commerce adoption growth rate, massive spike when people were forced to buy all their goods online. And now it is regressing to the mean.
I mean, mean reversion is a bitch. If you look at Shopify stock, if you look at Peloton stock, if you look at Affirm stock, if you look at ARK, a lot of these things were trending in a great direction. They had this short-term crazy behavior in the middle of all of this free money, and now they've mean reverted. And, we're in the midst of finding out what the real price is.